Hello, everyone. Welcome to the latest webinar from Silver Hill Funding. So glad you can make it with us. My name is Zach North, and I'm the marketing director here at Silver Hill. And I'm joined by Joe Altamonte, our head of business development. Welcome, Joe.
Thank you, Zach.
Really great for everyone to be here today. What we want to do with these webinars is create a kind of a new type. A solution spotlight. As you know, if you've worked with Silver Hill for a long time, we do webinars all the time. Sometimes it can be on marketing topics. We do a lot on sort of social media best practices, and we get a lot of good response on those. And then we do kind of overview presentations about what Silver Hill does, especially recently since our product line has expanded so much. We've had quite a few educational type presentations, which are great, and I love doing those. But we want to do here is create a series focused on one particular program, give you all the information you need to know about the specific program, who it's for, how you can grow your business with it, and when it makes sense, and also when it doesn't. And hopefully it's a recurring series that you see some value in and you want to join over and over. The best part about these, I think, is that once we're done, we're going to upload it to our YouTube channel, put them on our website, send you the recording, so you can reference it in the future. So don't feel like you have to take notes here. This information will be available. And at the end of the presentation, we're going to give you some ways to connect with us so you can have your questions answered. The last thing I'll say, despite this long introduction, is that this is going to be a pretty short presentation. And that's another thing I want to do with these solution spotlights. Just about 30 minutes or so, in and out, give you some time back in your day, and hopefully add some value. So with that, I will get into this. Just quick background on Silver Hill. You may have worked with us for a long time. I've seen the registrants, a lot of familiar names and faces, but always new people too, especially now since our company has gotten a lot bigger. We've grown our product set into some additional types of residential products, as well as our standard commercial small balance solutions. But this is us, one of the original small balance commercial lenders, with loans between 100,000 and 2 million, and a wide variety of programs. And that's what I'm going to kind of set the stage with before we dive in to the no doc streamline program specifically, where that fits in our product set and all that. So let me get into it here. Of course, we like to start with a poll question. So I'm going to launch that myself. Joe, bear with me 1 second. And here we go. So what we're asking here is how many commercial loans have you closed in the last 6 months? Why do I ask that? I think it really helps set the stage. I know I kind of say this every time. It really helps set the stage for Joe and me, because we kind of want to know who we're talking to. Maybe if we see that we have some inexperienced commercial originators here, we may take some more time over specific sections, program terms, maybe not use quite so many acronyms, which we'll probably do anyway, because you can't help it in this business. But we want to see that. Or maybe we've got a lot of experienced commercial brokers, in which case we can kind of run through a few things and get to the meat and the parts that we know that you'll want to know. So with that, I'm going to give it just a few more seconds. I see a lot of people voting here. Joe, I'm not going to ask you to guess. But anyway, I'll give it 1 or 2 more seconds. I see they're still coming in. Okay, so the majority, I'll tell you here, the majority of our attendees have closed between 1 or 5 commercial loans in the last 6 months. Although we do have about 30% who have not closed any. So Joe, I think that's a nice mix of some commercial experts and maybe some newer people who are looking to learn more about commercial lending. That's about exactly what we want, don't you think?
Perfect. Yep. Absolutely.
Cool. Okay. Well, in that case, we'll get back to it. Now, why no doc? And the simple answer is because we want to give you all the solutions to match all your clients' needs. That's something that everyone could probably say or want to say, but I think we actually do provide that. And I'm just going to show you How? By kind of asking some questions and then pointing to our answers. So if you've worked with Silver Hill in the past, you know what we're all about. But definitely a borrower looking to cash out equity from their existing commercial property. We've got flexible cash out solutions, fewer restrictions than traditional lenders. Or maybe, a lot of our business comes from takeouts, from higher rate, shorter term loans, sort of an intermediate temporary financing into a more permanent finance solution. We offer 30-year fixed rate loans. Maybe your borrower is an investor who fails a DTI test for SBA financing. Then that's why our DSCR program exists for those 1 to 4 unit investment properties. So even more into the residential side, your borrower wants to take out a higher rate short-term loan, sort of mention that. Your borrower's unable to produce tax return documentation required by traditional bank lenders. That's where we're going to spend our time here, talking about no-doc Streamline specifically. But you can see here that we sort of have a range of these reduced doc alternative programs, sort of non-bank programs, whether that's the owner-occupied bank statement program for those for self-employed small business owners who would rather show bank statements and tax returns, personal tax returns. Maybe the Light Doc Investor Program, obviously just for investors, and No Doc, which serves both. So hopefully with this, you're kind of seeing the spectrum with Silver Hill Funding. In all cases, we work with borrowers with good credit typically, but not always a willingness to submit tax returns. As you know, if you've worked with these types of borrowers, that's a very common need, especially with investors, and we do so much business with investors. So that's sort of the range going on now. Borrower attributes. Stock photo there, not an actual borrower of ours, but we thought it worked for the slide. As I mentioned, strong credit, possible DSCR issues, not willing to provide tax returns. So what this means for us is that we provide this solution, which is an alternative, and we recognize that, especially if you're newer to Silver Hill or you haven't worked with us that often, or you don't really have a full understanding of when our programs make sense, the no doc might not be your first thought, but what we're showing here is because of that approval methodology, in which case, we're using this alternative consumer data model, which provides a score that's used along with FICO, LTV in lieu of tax returns. You can see that this opens opportunities for you, even if no doc wasn't your first thought. And I'm kind of trying to illustrate what that means. So, like perhaps you come in thinking that this borrower would be a good fit for maybe our full doc program, our standard commercial program. But if they don't meet those DSCR requirements, they could be a fit for no doc. And so I think it turns some initial no's into yeses, or some initial I don't think so's into, yeah, I think we can. And I think that's what everyone wants to hear, and what we really pride ourselves in providing as solutions for you. In the same way, you could come in thinking no doc is the best fit, don't pass the risk test, doesn't seem like a good fit, but they actually could provide tax returns. Like, we could go back into full doc. And so I think that a simple kind of illustration there showing that what this program does, besides just help you grow with more closings, is help you find ways to do that loan with Silver Hill and get a really good solution for your borrower. I will say, before I pass it on to Joe, that this is our fastest growing program. I just kind of looked through the numbers myself, and it's very popular right now with our customers. So I think it made perfect sense for us to focus on this now. And so if this is not something you're currently doing with us, it might be a good idea to start, especially later on in this deck when I talk about our new promotion. Even more reason. So with that, not to just do some foreshadowing there, but I just did. Joe, maybe you can take it on and talk a little bit about the program specifically, a rundown, and then next we'll show how it fits within the rest of our commercial programs. So Joe, maybe you can take it from there.
Perfect. Thank you, Zach. And yeah, I was just thinking to myself that promotion will give you a lot of reason to look into this program. And in addition to, the promotion, because of the no doc nature of the program, it's simply a little bit easier to process on your end as well. So the rundown mirrors pretty much our basic small balance commercial program in terms of loan size and terms. Again, it's 100,000 to 2 million. There's a little wiggle room on the 2 million. There's no wiggle room on the $100,000. So we like to keep our loan sizes above that of a car loan into the $2 million range. Our amortization, we can do a 15-year AM. Most of our borrowers tend to choose the 30-year amortization. The 25 exists as well. Now, you'll notice they can do this for any purpose, from purchase to a cash out refinance. The LTV, and where we mitigate our risk, is a little bit lower than our general small balance commercial programs. So the purchase is maxed at 75%. So, before you even consider that, your borrower does need to have 25% down. Otherwise, on other programs, we can go up to 80% on small balance commercial for purchases. But for the no doc streamline, we're limited to 75%. And then on the refinance angle, it is at 70%. We also are looking at strong borrowers from a risk standpoint or a FICO standpoint. So 700 minimum credit score. And the DSCR, though, is rated at 1.0. So we relax that a little bit. And that, coupled with the lower LTVs, generally means that we're going to be in good shape on DSCR. So, so much as the numbers work out from a taxes and insurance standpoint as well. Plenty of options for prepayment penalties. The standard 5% declining 54321. You can lower the rate a little bit by stretching out your prepayment penalty to 7 years. I believe we can even go to 10. We can do a 5% 5-year prepayment penalty, or the shortest one we offer is a 3-year 5% prepayment penalty, which adds a little bit to the rate. You can price those out with your account executives specifically. But one thing about the prepayment, it becomes pretty clear when you talk to your borrower, rather than just read off the options, just ask them, what is your plan? What is your 5-10-year plan for this property? If they're looking to do something quickly, we might not be the best option for them because there's always going to be a prepayment penalty, understanding they can't predict the future. So if they say something like, look, I plan to be there for 5 years, but who knows, maybe a shorter 3-year prepayment penalty is in order. Or if somebody says, man, I hope I'm in this property for a long time, then you might stretch it out a little bit longer and give them a break on the rate. So that's the type of question you want to get into as well. Zach did a great job explaining that there's some factors in the underwriting methodology that give us the ability to not look at tax returns. So FICO, obviously, our LTV, as I mentioned, is limited. And then that third-party consumer credit information. And I will just say a rule of thumb is, if a borrower has over a 700 credit score, they generally will pass that risk test on the third-party consumer credit score. So it's a very rare occurrence. It's not, it happens, but not often. But again, Zach made a great point. If for some reason they don't pass that test, maybe experience-wise or so forth, there still may be an option for them with our other programs. We can buy down the rate just as we can with any of our programs. All right, 3/8 of a point will cost a point up front. All of these loans must close in the name of an entity. That's usually not a problem. Many of the borrowers doing this program prefer to keep it in the name of an entity. Keep an eye on the population. Keep an eye on the location of the property. If you look at a map and you can't see a city for a long ways, we're going to probably have an issue with it. So, Google map it, then Google the population of the county it's in, run it against the top 200 MSAs in Wikipedia, whatever you need to do there. And if you're still not sure, we have a tool that our AEs can plug the zip code into, and it'll give us the answer right away. And then this is eligible for all of the property types that we offer. So they're listed there, won't read them off to you, but one important update is very recently we've reintroduced the ability to lend on restaurants and bars and the ability to lend on daycare centers. Those two properties, both with their caveats. meaning restaurant and bar. Keep in mind, we're only lending on the real estate, not the liquor license, not the furniture, fixture, and equipment, not the value of the business itself, just the real estate. With a daycare center, it's the property that we're concerned with. So if this person goes in the morning, opens the building up with a key, does her daycare, closes it, and goes to a different home to sleep at night, that's typically okay. If this person gets out of bed, walks downstairs, flips a sign around in her living room, and says Mary's Daycare, that's typically a house, and we will not lend on something like that.
Cool. So, Joe, before you go on to the next slide, we got a question that's going to be perfect, which is, hey, what's the difference between light doc and no doc? And that's what this next slide is going to show, because we're going to show our commercial programs kind of in a comparison view. But I think in one of the basic senses is when I put this together, I probably undersold it, because with the income documentation row there, it's no tax returns, but also no bank statements, no operating statements. Silver Hill won't ask for those things. And so it's not merely the tax returns, but truly no doc as far as what Silver Hill will ask for. And we'll explain what that means when you get into the underwriting part and what a third party may ask for down the road. But anyway, that's a core difference. A few other differences that Joe was kind of alluding to, but in this next slide, I think, as I'm able to get to it, yes, here you can see light doc right next to no doc and how all the programs kind of stack together. So maybe Joe, I'll get back to you now.
Thanks, Zach. Yeah, great point. And this really is a slide, and we do share these presentations with you following the presentation. So great slide to kind of have in your Silver Hill funding file, maybe even taped onto the front of it, because, look, our AEs, their job is to help you align your borrower with the right program. But, when you're dealing with your borrower initially, it can't hurt to know exactly, the differences between the programs. So this slide is really, really powerful here. So you can see the light doc and the no doc lined up right next to each other. Very similar, but again, Zach mentioned that the bank statements and operating statements oftentimes is the difference between the two, and the rates only a sliver different. I think it comes down to maybe a quarter point on the rate. So not a whole lot of differences there. So I went down the loan terms line by line in the no doc streamline. So there's no point in going through those line by line for no doc streamline, but you can see some differences there between, say, full doc, where we're going to do a global DSCR with the operating statements, the tax returns, the bank statements. We need 2 years of those, but believe it or not, the rate is not a big jump from full doc to no doc streamline. And one of the reasons is we keep our minimum credit score above 700 for the no doc streamline. So if you notice the other programs, a 650 floor, well, somebody's not going to be showing us any documentation. We mitigate our risk by making sure they have a strong credit history and that our LTV is not overly aggressive. So those are the biggest differences between all of the other programs. And by the way, we are talking about the no doc streamline today, but we are Silver Hill Funding. We do offer these 4 programs. If one of these jumps out at you, other than the no doc streamline, give us a call. We'll be happy to put it through the through the system for you. Zach?
Yeah, exactly. And I got another question here, and maybe I'm just going to answer questions in the middle. But the ones I have quick answers for. It says, wait, is no doc just for 1 to 4 or for all commercial property types? And to be clear, it's for all of our commercial property types. The program you don't see here from Silver Hill Funding is our DSCR program, which is our solution for 1 to 4 unit investment properties. Here I wanted to illustrate just our commercial roster and a comparison of those products. And if you've been with us on our last few presentations, you know too that we have other sort of agency products on the resi side, other types of alternative investor solutions with based on Bayview's securitization capability. All sorts of solutions are available. I don't think a slide would be big enough, or I would run out of rows or columns to show all the different things that we're offering to mortgage professionals today. But this is our small balance commercial offering and how it stacks up. And I think it's a pretty useful view, even though you see there's a lot of similarity here. a couple key differences, and here's no doc. So with that,
And
yes,
yeah,
sir.
Zach, one point that it may be indicated somewhere else in here, but just in case it is not, I'll say, if it is later, we'll save you the 2 seconds then. But, we're saying no doc, and that's from an underwriting standpoint. Just for the avoidance of doubt or any confusion may come up when the appraiser goes to see the property. In some instances, if it's an investment property, they may ask for leases. They may ask for a rent roll, and we're talking about the appraiser. And so those documents are requested by the appraiser for the purposes of valuing the property. They are not shared for underwriting purposes. So they're going to be, again, requested by the appraiser. And so sometimes we do get a call saying, wait a minute, no, doc, why is the appraiser asking for leases, or why is the appraiser asking for a rent roll for this particular property? And that, again, is for the sake of valuing the property.
Right. With that,
so I might have saved Zach 2 seconds later on.
Much appreciated. Well, let's look at a few case studies, Joe. I think you can keep going here, and as we always do, highlight a few of our very recently closed loans, so you could see what we're doing.
I love the pictures. Yeah, thanks, Zach. And I love the pictures in these, because sometimes you don't have these in your mind. When you think of commercial, sometimes you might think a little bit bigger property, or you think of a mall or something like that. But these are things that we pass by every day on Main Street, USA. So you go to Bayshore, New York. Probably have to go that far up on Long Island to get into the property values. But a $420,000 loan amount, pretty conservative LTV there. We like to point out the compensation. And so the first property there took advantage of our promotion. And if you can do math, it looks like we're giving a point away. So $4,200, won't steal Zach's thunder later, but $4,200 extra for a total of $16,800 on a office building, freestanding, nice little office building in Bayshore, New York, which is on Long Island. So very nice deal. Then we go to Ohio, multifamily. Looks like it's probably on the upper end, but still a $581,000 loan. So location. Broker was very generous in terms of his fee. So 1 point for the broker, a 5-year ARM, 70% LTV. I would imagine, again, every deal is different. Looking at that property, it's nice and clean. Borrower was probably buttoned up. So the broker said, look, I'm not going to price myself out of getting this deal. So that's a consideration to always have as well. Then we go out to Colorado Springs for a retail space. Nice little property there, 71% LTV. Broker made $10,300 on the deal. So looks like a couple of points, maybe 2.5 on that. Now keep in mind, this is total compensation. It includes yield spread and or upfront broker points. Yield spread is still a thing for those of you that are new to commercial. In commercial, yield spread still exists, and it's very common. Yield spread is not disclosed on the settlement sheet as well. So it is paid for outside of closing through an ACH payment between us and the broker. So good thing to know in terms of that. Again, the one thing about yield spread to be careful of is obviously it hits the rate, and then that can affect the DSCR. So just be careful that we're not putting all of our eggs in the yield spread basket, that you are protecting yourself with upfront fees. Also, when there is no upfront fees, the borrower, that becomes a little suspicious to a borrower as to how you're even making money. So those things can be taken into consideration. Back to New York, an office space for $525,000, 5-year ARM, and that broker made out well on that particular deal too. So some, unlike residential, no maximum compensation other than the amount of points we allow. We allow a maximum of 3 points up front, and we allow a maximum of 2 points yield spread for a combined maximum of 5. So rarely do brokers take advantage of 5 points, but we do see an average of 2 to 3, a combination between the two.
Right. Well, thanks, Joe, for that rundown. Got a question, which I'm sure on a lot of people's minds. Hey, what's the rate? And so actually, it was kind of hey, what's the rate, bud? For these decks, I used to show like the whole kind of rate range, but then it changes. It's not always the most helpful to show it that way. We show it quickly and then go on to the next slide. So for the full rate matrix, definitely reach out to your regional manager, your rep at Silver Hill, and they can walk you through exactly how the rates stack up. Now, like sort of on the low end is about 6.25, and so for these types of loans, naturally the rates are going to be a little higher than for our complete or full doc or kind of standard commercial program. But we've seen that borrowers are okay with that because of the kind of obvious trade-off, where we're getting this no doc solution streamlined like we have in the title. So it's just a different type of loan. And like I said, like I was looking at the pipeline, looking at our numbers recently, and this program is really jumping off right now with our broker partners. So hopefully these 4 loans, all recent in the last month or so, you kind of get a sense of what these loans look like. And why we're talking about that is because the next slide is a poll, the last one we're going to do, and it just says, are you seeing these types of scenarios today? A simple question. And of course, if you're doing the commercial loans, like those look like standard commercial properties. But more so, are you seeing these commercial properties? Yes, but also the types of borrowers who might be a fit for this program. This is helpful, again, for kind of steering the conversation, but also because we can connect you if you are seeing these deals. And I offer that third option. I might be, but I need more help knowing what to look for. Super helpful if that's the case, if you want to answer that, because we can connect you with a rep who can show you that and who can walk you through situations where it might be a good fit and where it would not be, because it's not always obvious. So anyway, this was a pretty basic question, so I don't need to keep it open for too much longer. Looks like so Joe, if you can believe it, 0% said no. So we've got we are not anymore. So one or two people said no. I spoke too soon. But the vast majority, we have about 80% saying yes, and of course just a little below 20% saying I might be. So that's great. And I thought that'd be the case because these are the properties we work with, and so I think the no doc makes a lot of sense for a wider range of these scenarios. So anyway, I'm going to close that. Beautiful. And move on. And I said 30 minutes, so we'll kind of I think those are the longer parts. So bear with us here as we go through some very important parts about how the underwriting works, because you wonder, like, no doc, how's that possible? And so I'll just take over really quick here, Joe. And as we mentioned, we're looking for borrowers with strong credit. So the FICO is going to play into it, LTV going to play into it. And then the third part is this consumer data, generate this proprietary alternative data model. Creates a risk score, not the only criteria used. And as Joe mentioned, you can kind of cheat a little bit because you can see if that FICO score is high, these things have a correlation in many cases. So how does it all work? Consumer info from public records that may not appear on Bureau credit reports. And so this just creates more of a worldview of creditworthiness without having to ask for some of the traditional documentation, as obviously tax returns, but then also like bank statements, operating statements, things like that. Silver Hill will not ask for those documents for a no doc loan. Someone asked, is this being recorded? And yes, it certainly is. And better than that is that I will send, or Silver Hill will send you this recording tomorrow, so you'll get it. You don't even have to look for it. We'll put it straight in your inbox. Moving on. So this is important too, because as we always do, we say, well, okay, what do we need to issue an LOI? So it's pretty simple for no doc. An application, the tri-merge credit report, and the purchase contract if available, if applicable. But see, here we add the caveat where we mention this in all our marketing materials and all our documents with no doc, is that when we say no doc, obviously Silver Hill is not going to ask for these documents. An appraiser might though, especially, like a rent roll, operating statements, leases, that could happen. And so we state that from the get-go. Silver Hill will not ask for these things. Appraiser, third party, they may as they evaluate the property. So we want to list that there, but Silver Hill will not. And you can see it takes very little to get started with us. And I think, as Joe mentioned, from the borrower's perspective, now that it only takes a $500 deposit to get the loan in process, it really doesn't take a lot for a borrower to get that loan in motion with us. We think that's a pretty competitive aspect we've added to our transaction process, is that very low, flat $500 fee to get the loan in motion. So we think all these things together make it a pretty simple process, and one that I think a borrower is going to appreciate. So with that, to move on. And Joe, maybe you could come back here and talk about broker benefits. You alluded to it a little bit, but just to kind of emphasize, especially since, and I can just add before I hand it off to you, that we have a lot of new people talking to us these days, working a lot of new mortgage professionals, as you can imagine, in today's industry with rates kind of going up, some volatility, people unsure on the resi side. We've got a ton of residential mortgage professionals looking into commercial, looking to diversify with small balance commercial loans. That's always been a sweet spot for Silver Hill, and compensation is a major part of that, just because you're able to get paid differently and more on the commercial side. So maybe, Joe, you can kind of walk through how this works, especially from maybe the perspective of an originator who isn't familiar with closing commercial loans.
Yeah, it's a perfect segue, Zach. And I got ahead of myself a little bit earlier, but we were talking about specific deals. So just wanted to put some context behind where those dollars are coming from. And this is where it's spelled out for you, in that you could take advantage of the, whereas in your, for those of you who are primarily residential brokers, you pick a comp election and a minimum and a maximum for certain lenders, and you're within that, range, and it's a volume based, really. Your income is based on volume more so than a home run, so to speak. Well, not that we're going after home runs on every deal, but some of them can, the bigger the deal, obviously, and the more money you can make, and you can make up to 5 points, as I mentioned earlier. 3 in origination, which is disclosed on the settlement sheet, 2 in yield spread. And to elaborate a little bit on what I was talking about, don't put all of your eggs in yield spread, is if the deal's in process and maybe the appraisal is a little low or something comes up in the process of the deal, and in order to make the DSCR fit, one of the things we look at is, well, if there's YSP in the deal and one of those or 2 of those go away, this deal will work. Well, if all you're making is yield spread and we have to take 2 points away in yield spread, then you're a volunteer broker, and no one likes to do that. That's not why you're here. So make sure you do give yourself some, people will expect in the commercial world, they'll actually be a little bit weary if they don't see points up front. So, protect yourself. If you can make yield spread, that's great. But just keep in mind, if something goes sideways in a deal, that's one of the things we have as wiggle room to make a deal work. And again, not disclosed at closing, paid after closing. So you'll get your upfront fees as part of the closing. And then a little bit later, you get a bonus check for that YSP. All right. So Zach is the man when it comes to unbranded marketing collateral, or actually I should give his whole team credit. He's got a great roster of folks that can help him get you some marketing collateral to help grow your mortgage business, where you can plug in your information and market it to your referral network. They can be realtors or insurance agents or so forth. So take advantage of Zach here.
Yeah, I mean, we get it. We're orange, we're bright, that's unique. Our unbranded materials are not. we leave them unbranded, give you space to put your logo, your contact info. All we're really doing is putting our program benefits there, so you don't have to even remember that. And marketing, it's expensive and it takes a lot of time. And so we want to give those tools for you. last thing I'll say about the point structure, Joe, is yeah, it's smart to not just rely on YSP, and that's why Silver Hill does not offer or charge lender points, origination points. So we want to give you the space to structure fees the way you want to, and I think that's part of our perspective on brokers and how we're trying to help you run your business the way you want to. So just thought I'd toss that in there. Joe, I think we're kind of getting started point.
All right.
So maybe you can just tell us a little bit about this promotion that's running right now for no-doc exclusively. So perfect timing.
So 50 basis points on all no-doc closings. And Zach, refresh my memory. How long is that running now?
It's going to run for a while. This is, a marketing person always wants to say for a limited time only, act fast. You only have one day. That's not the case. This is going to be around. We want to give you time to really take advantage. And we understand maybe this program's new, so you might not have that scenario today. But we're going to run this for a good bit of time, more than a month, because we really want you to take advantage. But yeah, it just started at the beginning of March.
Awesome. So there is some legalese that you can read through when you get this deck down on the bottom right of the screen. So, but for borrowers, there's a benefit too. So it's not just, hey, broker, make more money, give us deals. It's, listen, what's in it for the borrower? Well, they can get a free appraisal, meaning the appraisal's on us. We will not charge the balance of the appraisal at closing. That is nuts. So we're going all in on the no-doc program for a limited time until we decide that we have enough no-doc loans where everybody's we don't need to do our through the end of May is when we're going to do this, and so really good, especially, and if you're new to commercial or maybe still learning, the appraisal fee can be expensive on a commercial loan. So that's a substantial benefit for the borrower, and of course, a substantial benefit for you as well. That's additional 50 bits on these loans charged, outside of the closing. So we're really excited about this. You're going to see a lot of promotion about no-doc and this promotion in general, and you're kind of seeing it for the first time here. So you've got the advantage. Thanks for joining. Zach, we're unofficially calling this the Oprah promotion. You get a free appraisal.
Yeah, right. Exactly. So. Thank you. I wish you had joined our last marketing meeting. We could have put that in there. So yeah,
it's too expensive to lock down as a spokesperson.
Right. Yeah, that's a maybe. That's a maybe for her probably. So here and here, Joe, if you want to keep going, this is kind of where our sales team is located. If you don't have a partner, you can kind of see.
Yep. And you'll notice down at the bottom left where we don't do loans. So there's a couple where you might raise an eyebrow. Geez, why aren't you in Michigan? We're still sore from the first real estate bust in Michigan like 15 years ago. It's still really, it's affected us really poorly as a company. So still not in Michigan. And some of the other states, we don't think there's going to be a whole lot of demand, so we're not really looking into them. Nevada, the exception. Keep your ears open on Nevada. The only reason we're not in Nevada is you need brick and mortar in Nevada, and we might have a solution for that soon. Stay tuned. One of the newer states is Tennessee. That was on our ineligible list as recently as about 6 months ago. And we now do loans in Tennessee. So, and then of course on the right side of the screen, you'll see your reps. Now your rep might not necessarily be lined up exactly with where you are, but you can certainly contact and ask for one of those folks if you're new to us, based on time zone and where you feel most comfortable.
Yes, and all their contact information is on our site. So you just hover over the area and you'll see their email address, and so it's really easy to get in touch.
Cool.
But with that, I think that's it, Joe. Thank you so much. Everyone, if you're on this call, you don't have a rep, you don't really know who to talk to, it's really simple because my information is right here, and so is Joe. So, contact Joe, super easy. Just talk a little bit about yourself, what you're interested in, what you'd like some help with. We have a very, very good team full of really experts. And we're not just saying that, real commercial experts who really know the properties, and more importantly, know the scenarios. And so if you talk a little about your scenario, They can tell you what would be a great fit, show you what the differences would be, and help you make a smart decision for your client. But anyway, we've got our general number there, our general site, silverhillfunding.com. Any other information we'd be happy to help with. And as you mentioned, this whole webinar is being recorded, and we're going to send it to you tomorrow so you can review it again. So anyway, Joe, thank you so much for joining. Hopefully you learned more about NoDoc, why it's our most popular program right now, and how it's going to get even more popular when more brokers hear about this really cool promotion we're running. So hopefully this has been helpful for you. Let us know. And Joe, anything you'd like to say to take us home?
Just thank you. And, feel free to contact us. We can get you approved. And, in fact, you can submit a NoDoc loan before you're approved. So if you have something you want to send in, we can get you going right away.
Awesome. Okay, everyone, have a great rest of your day and hope to talk to you soon.
Thanks, guys.